decades, the US has been the dominant force in American trade, dictating terms on electric vehicles, critical minerals, and manufacturing. But Canada just flipped the script in a move that no one saw coming. 18 massive infrastructure and resource projects have been fast-tracked, setting Canada on a path to economic self-reliance and leaving American automakers scrambling. This all started with US trade policies meant to pressure Canada into submission, but instead of folding, Canada doubled down, secured new trade partners, and is now leading the race in electric vehicle production. The result? A potential supply crisis for US automakers, skyrocketing EV prices, and a historic shift in power. Is this the beginning of the end for US dominance in the auto industry? What's happening? Canada has been the largest energy supplier to the United States, providing an uninterrupted flow of crude oil, natural gas, and uranium to fuel American industries, power homes, and support the country's growing energy demands. Nearly 60% of the crude oil imported by the United States originates from Canada, along with 99% of imported natural gas. Additionally, Canadian uranium fuels nuclear reactors that generate electricity for 1 in 5 American homes. This energy relationship has been a pillar of economic stability between the two nations, ensuring affordable fuel prices and reliable energy access. But now, things are changing. With escalating trade tensions, Canada is rethinking its dependence on the United States as its primary energy customer. A combination of tariffs, political disputes, and economic uncertainties has prompted Canada to diversify its trade relationships, reducing its reliance on a single market. The Canadian government is accelerating efforts to redirect energy exports to Europe and Asia, signing new agreements with Germany, Japan, and South Korea for long-term energy partnerships. This shift is not just about economics, it is a strategic move. The United States has long assumed that Canada's energy would always flow south, but now Canada is signaling that it no longer wants to be a passive supplier at the mercy of American trade policies. By investing in liquefied natural gas terminals, expanding its east-west pipeline networks, and modernizing its energy infrastructure, Canada is securing the ability to sell directly to global markets, bypassing the United States altogether. For American businesses and consumers, this could be a disaster in the making. If Canada significantly cuts back oil exports to the United States, fuel prices could double overnight, leading to a ripple effect across the economy. The automotive, aviation, and manufacturing sectors, all heavily dependent on stable energy costs, would face crippling price hikes, while everyday consumers would feel the impact at the gas pump and in their utility bills. The energy trade war between Canada and the United States is no longer a hypothetical scenario. It is happening now. And as Canada continues to seek new buyers for its resources, the economic consequences for the United States could be severe. But energy is only the beginning. Canada's next move could send shockwaves through one of the most critical industries in North America, the electric vehicle market. The EV crisis. As the world moves toward clean energy and electric vehicles, the race to secure critical minerals has become a battleground. The production of EVs relies on lithium, nickel, and cobalt, key minerals used in battery manufacturing. Canada happens to be one of the richest sources of these essential materials, making it a crucial supplier for American automakers like Tesla, General Motors, and Ford. But just like with energy, Canada is shifting its priorities. Instead of serving as a raw material supplier to the United States, Canada is looking to become a global EV powerhouse itself. By investing in battery manufacturing plants, mineral refining facilities, and domestic EV production, Canada is positioning itself as a self-sufficient player in the global electric vehicle market. For American automakers, this is a potential nightmare. If Canada restricts exports of lithium, nickel, and cobalt, US companies will be forced to rely on China and other foreign suppliers, making them vulnerable to higher costs and supply chain disruptions. China already dominates the EV battery market, and if Canada pivots away from supplying the United States, American automakers could lose their competitive edge in the global EV race. Meanwhile, Europe and China are actively negotiating with Canada to secure exclusive access to these critical minerals. If Canada shifts its focus to European and Asian partners, the United States could fall behind in the transition to electric vehicles. This shift raises a critical question. Is North America's EV revolution at risk of stalling before it truly takes off? But Canada's shift in trade priorities didn't happen in a vacuum. It was a direct reaction to US policies that backfired spectacularly. Tariffs that backfired. The United States has historically used tariffs and trade restrictions to maintain leverage over its trading partners. But when Washington imposed heavy tariffs on Canadian steel, aluminum, and EV battery materials, it triggered unintended consequences that are now reshaping the economic relationship between the two nations. The logic behind these tariffs was simple: to strengthen American industries by reducing competition from Canada. However, instead of backing down, Canada responded by doubling down on economic independence. Rather than relying on the United States for manufacturing and refining, Canada accelerated its domestic industrial projects. Billions of dollars have been poured into infrastructure, expanding ports, pipelines, rail networks, and trade routes to make Canada less reliant on US supply chains. One of the biggest shifts came in the steel and aluminum industries. After facing US tariffs, Canada pivoted toward new trade agreements with Europe and Asia, strengthening relationships with partners like Germany, Japan, and South Korea. Meanwhile, American manufacturers struggled with rising costs, as they were forced to pay higher prices for materials that had once been easily sourced from Canada. The result? Instead of weakening Canada's economy, these tariffs push Canada to become more independent, creating new trade opportunities that leave the United States at a disadvantage. And Canada isn't stopping there. With a historic $300 billion investment, the country is making moves to reshape its economy for the future. A $300 billion plan. Canada's response to US trade pressures isn't just about retaliation, it's about long-term economic transformation. The Canadian government has announced a $300 billion investment strategy aimed at modernizing transportation, energy, and resource development to fast-track economic independence. A cornerstone of this strategy is the Gordie Howe International Bridge, a multi-billion-dollar project connecting Detroit and Windsor. Once completed, it will provide a critical trade route, allowing Canada to export goods directly into the US without relying on existing American-controlled infrastructure. Meanwhile, the Trans Mountain Pipeline expansion is set to increase Canada's crude oil export capacity, making it less dependent on American refineries. At the same time, billions are being spent on railway expansion, port upgrades, and new transportation corridors, ensuring that Canada can trade more efficiently with Europe and Asia. With these bold investments, Canada is not just reacting to US policies, it is actively designing a future where it holds more economic power. If successful, this strategy could permanently reshape North American trade, shifting the balance of power away from Washington and toward Ottawa. Canada isn't just reacting, it's making bold moves that could reshape the entire energy and auto industry. Pipelines, ports, and power grids, rewriting the trade map. One of the biggest shifts is in Canada's oil and gas industry, which has historically been dependent on American refineries. Over 75% of Canada's crude oil exports currently go to the United States, but new pipeline expansions are cutting Washington out of the equation. The Trans Mountain Pipeline expansion, set for completion in 2024, will triple Canada's capacity to export oil to Asian markets, allowing Canada to ship its resources directly to foreign buyers without relying on US refineries. This is a game changer, reducing American leverage over Canadian energy and positioning Canada as an independent global supplier. At the same time, Canada is investing billions into expanding its ports, particularly in Vancouver and Prince Rupert. These ports serve as the gateway to Asia and Europe, allowing Canada to increase trade with global markets while bypassing the US entirely. Prince Rupert, already one of the fastest growing ports in North America, is undergoing a major expansion that will increase its capacity by over 60% in the coming years. The goal is clear. Canada no longer wants to be dependent on the United States as its primary trade route. Beyond pipelines and ports, Canada is also modernizing its power grid to support this economic shift. By investing in high-voltage transmission lines, Canada is securing energy independence, ensuring that it can sustain its industries and exports without relying on American infrastructure. This comprehensive trade overhaul is not just a reaction to US tariffs, it's a calculated move toward economic sovereignty. While Canada is revolutionizing its trade routes, it's also making massive strides in energy, especially in renewables. Could Canada leave the US behind in the global green energy race? Green energy revolution. Will Canada lead the next global shift? The global energy landscape is changing, and Canada is determined to be at the forefront. While the United States remains deeply invested in fossil fuels, Canada is accelerating toward a renewable future. With government-backed initiatives and private investments surging, Canada is rapidly expanding its wind, solar, and hydroelectric power sectors, a shift that could make it a major clean energy superpower. Canada is already a leader in hydropower, with over 60% of its electricity coming from hydroelectric dams. However, the country is now doubling down on solar and wind power, making record investments in renewable energy projects. The federal government has pledged $11 billion to advance clean energy technologies, including battery storage, green hydrogen, and offshore wind farms. One of the biggest advantages Canada has is land availability. Unlike densely populated regions in the United States, Canada has vast open spaces perfect for large-scale renewable energy projects. This has led to a solar boom, with solar capacity growing by 92% over the past 5 years. Wind energy is seeing similar growth, particularly in provinces like Alberta and Saskatchewan, where new wind farms are being built at an unprecedented pace. This rapid expansion is not just about domestic energy needs. It's also about positioning Canada as a global clean energy supplier. Europe and Asia are desperately seeking reliable green energy sources, and Canada is strategically placing itself as the solution to their energy transition. Meanwhile, the United States is struggling to balance its fossil fuel dependence with renewable energy goals. With political gridlock and outdated energy infrastructure, America's green energy shift is progressing much slower than Canada's. If Canada continues this trajectory, it could outpace the US in clean energy exports, attracting international investments that would have otherwise gone to American firms. Canada isn't just leading in energy, it's making moves in another major industry, electric vehicles. Could this spell trouble for American automakers? Is this the end of American manufacturing dominance? The United States has long been the powerhouse of North America's automotive industry, with Detroit at its core as the global epicenter of car manufacturing. But now, Canada is making bold moves that could disrupt this dominance. The Canadian government is investing billions into EV battery production, positioning the country as a global leader in electric vehicle supply chains. Unlike the United States, which relies heavily on foreign imports for critical EV minerals, Canada has vast reserves of nickel, lithium, and cobalt, key ingredients in electric vehicle batteries. This has led to a surge in battery gigafactory projects, with companies like Volkswagen and Stellantis setting up major facilities in Canada. Tesla, General Motors, and Ford depend on Canadian minerals to power their EV production. However, with Canada increasingly prioritizing domestic manufacturing, American automakers could soon face supply chain disruptions and higher production costs. The shift is already happening. Canada is aggressively luring automakers to set up plants within its borders by offering massive subsidies and tax incentives. If this trend continues, Canada could become the EV hub of North America, while the United States struggles to maintain its once unquestioned dominance. The question is, can American automakers adapt before it's too late? Canada's transformation isn't happening in isolation. It's actively securing new trade partners to solidify its economic independence. Is the US losing its grip? The rise of Canada's new trade partners. Is the US losing its grip? For years, Canada's trade policy has revolved around one country, the United States. Nearly 75% of Canadian exports have historically gone south of the border. But with increasing economic tensions and Washington's aggressive trade policies, Canada is taking a different approach, one that could significantly reduce its dependence on the US. The Canadian government is rapidly securing new trade agreements with Europe, Asia, and emerging markets. Deals with the European Union, the United Kingdom, and Japan are strengthening Canada's ability to export energy, technology, and natural resources to a wider range of global buyers. The country is also deepening economic ties with China, despite ongoing geopolitical tensions. Perhaps the biggest shift is Canada's push to export liquefied natural gas directly to Asian markets. The first major Canadian LNG export terminal, backed by Shell, is expected to begin operations in 2025, reducing Canada's reliance on the US energy market. As Canada expands its global reach, Washington is watching with concern. The United States has long enjoyed economic leverage over Canada, but with these new trade routes and agreements, that control is slipping. The question now is, how will Washington respond? Will the US try to regain control, or is it too late to stop Canada's economic independence? The consequences of Canada's trade shift are about to hit the United States. Could this trade war trigger an economic crisis? The supply chain nightmare. The automotive sector in the United States depends heavily on Canada's resources to keep its production lines running. Canada provides steel, aluminum, lithium, nickel, and rare earth elements, all essential for manufacturing everything from traditional gas-powered cars to the latest electric vehicles. However, with the ongoing trade conflict between the two countries, these critical materials are no longer flowing as freely as before. The result? A supply chain crisis that could send car prices skyrocketing and push the American auto industry toward a breaking point. At the heart of the issue is the rising cost of raw materials. Without Canadian metals and minerals, automakers must source these materials from alternative suppliers, often at much higher costs. The global market for battery metals in particular has already been strained due to increased demand from China and Europe. As a result, US manufacturers are facing higher production costs, extended wait times, and shrinking profit margins. These disruptions are already impacting dealerships and consumers. New vehicle inventories are tightening, and prices for both new and used cars are climbing at an alarming rate. Over the past 3 years, the price of an average new car in the US has risen by over 30%, and analysts warn that if supply chain bottlenecks continue, those prices could jump even higher. For consumers, this means tough decisions ahead. Those in the market for a vehicle may find themselves paying a premium or facing months-long wait times. Meanwhile, automakers are struggling to balance costs while still keeping production running. But the crisis doesn't stop at traditional vehicles. The electric vehicle sector is facing an even bigger challenge. Can Tesla and GM survive? The electric vehicle market is at a crossroads, and the Canada-US trade war has put its future in jeopardy. North America was supposed to become a leader in EV production, but with critical mineral shortages, rising costs, and increasing competition from China, American automakers are fighting for survival. Tesla and General Motors, two of the biggest players in the EV industry, are now scrambling for alternative suppliers. Canada has some of the world's largest deposits of nickel, lithium, and cobalt, all essential for manufacturing EV batteries. However, with Canada tightening control over its resource exports, these companies are facing supply gaps that could slow production and drive up costs. China, meanwhile, has been strategically expanding its dominance in the EV supply chain. With its massive battery production capabilities and control over global mineral reserves, China is poised to fill the void left by Canada's shifting trade policies. This puts American automakers in a dangerous position. Without reliable access to affordable materials, they risk falling behind their global competitors. The effects of these supply constraints are already visible. Over the past 18 months, Tesla has been forced to adjust its pricing multiple times to account for fluctuating costs. General Motors has delayed several EV rollouts, citing supply chain uncertainty. Meanwhile, Ford and other manufacturers are reevaluating their battery production strategies to reduce reliance on foreign materials. If the trade standoff continues, the US risks losing its foothold in the EV industry altogether. While companies like Tesla revolutionize the market, China's aggressive expansion and Canada's newfound independence could mean that North America will no longer be the center of EV innovation. But while US automakers struggle, Canada is seizing the opportunity to redefine its role in the global auto industry. The big shift. Could Canada become the next auto powerhouse? One of Canada's biggest moves has been attracting battery gigafactories to produce EV components domestically. Automakers from Germany, Japan, and South Korea have been drawn to Canada's abundant natural resources, government incentives, and growing skilled workforce. Companies like Volkswagen and Stellantis have already committed billions to building new facilities in Canada, signaling a major shift in auto production power. The Canadian government is also incentivizing local manufacturing, offering tax breaks, infrastructure investments, and direct subsidies to automakers willing to set up shop within its borders. This has led to a surge in automotive job creation and a shift in industry attention away from the US. If these trends continue, Canada could surpass the US in vehicle and battery production. This wouldn't just mean fewer American-made cars, it would also weaken the US economy as manufacturing jobs shift northward. The real question is, can Detroit fight back, or is Canada on its way to becoming the new auto capital of North America? As the industry shifts, consumers are left wondering, should they buy now or wait for a better deal? Consumer warning. With so much uncertainty in the auto industry, many consumers are asking a critical question: is now the right time to buy a car, or should they wait? The answer isn't simple. On one hand, if supply shortages continue, prices for new and used cars will keep rising, meaning waiting could cost consumers even more. Additionally, some manufacturers are offering incentives and discounts to move inventory before production costs increase further. For buyers looking for immediate availability, locking in a price now might be the safest bet. However, experts warn that the market is volatile. If trade tensions ease and supply chains recover, car prices could stabilize or even drop. Some analysts predict that by late next year, we could see a surplus of unsold vehicles, leading to potential price cuts. Leasing may also be a smarter option than buying during this uncertain period. With leases, consumers can avoid long-term depreciation risks while benefiting from lower upfront costs. If prices drop in the future, leaseholders won't be stuck with an overpriced vehicle. Ultimately, the decision depends on how the trade war unfolds. If the US and Canada fail to reach an agreement, supply constraints will persist and prices will soar. However, if a resolution is found, consumers who wait might score a better deal. But this trade war isn't just about cars. Canada and the US are clashing on multiple fronts. The agriculture battle. Could food prices skyrocket? And for decades, the United States and Canada have enjoyed a deeply connected agricultural trade relationship. Canada is a top supplier of wheat, dairy, beef, and fresh produce to the United States, ensuring stable prices and a reliable food supply for American consumers. However, as trade tensions mount, this critical partnership is now at risk. If tariffs and export restrictions intensify, the cost of essential Canadian agricultural goods could rise sharply in American supermarkets. Canada supplies nearly 30% of all fresh fruits and vegetables imported into the United States. It also provides over 70% of all canola oil, a key ingredient in packaged foods. Additionally, a significant share of beef and dairy products comes from Canada, helping to keep meat and milk prices stable. With restrictions on these imports, American businesses will scramble to find alternative suppliers, leading to higher costs for farmers, retailers, and ultimately, consumers. Grocery stores already struggle with inflation, and a breakdown in US-Canada agricultural trade could push prices even higher. American farmers who rely on Canadian fertilizers and grain imports may also see production costs rise, compounding the issue. With Canada seeking new export partners, American consumers may soon be competing with international buyers for the same Canadian food supply, driving up costs even further. As food prices climb, another critical industry is facing its own crisis: the retail sector. Will American shoppers soon see Canadian products vanish from store shelves? The retail war. Beyond food, Canadian goods play a major role in US retail markets, supplying everything from lumber and construction materials to clothing and packaged goods. If trade restrictions increase, consumers will notice the impact everywhere, from home improvement projects to the clothes they wear. Canada is the largest supplier of softwood lumber to the United States, providing over 80% of the materials used in construction. If tariffs or export controls disrupt this trade, American home builders will struggle to meet demand, causing housing costs to rise due to more expensive building materials. A slowdown in construction projects could also lead to job losses and economic stagnation. Additionally, home renovation costs would increase, making it more expensive for American homeowners to maintain or improve their properties. Beyond building industry, Canadian clothing brands, furniture, and packaged consumer goods are widely sold across the United States. If tariffs increase, these products could become significantly more expensive, leading to price hikes across major retailers. In some cases, Canadian products may disappear from shelves entirely, forcing consumers to buy alternatives that may be lower in quality or costlier. Supply chain disruptions could also cause delivery delays and inventory shortages, further frustrating consumers and retailers alike. Major US retailers rely on Canadian suppliers for consistency in pricing and stock availability. If these supply chains break down, companies could cut jobs or pass higher costs to consumers, further straining American wallets at a time when inflation is already a concern. The stakes have never been higher. Will the United States and Canada find a way to mend their relationship, or is this trade war just the beginning of an economic divide? The future of North American trade. The next few months will be critical in determining whether the US-Canada trade war escalates or reaches a resolution. But as both nations dig in, one thing is clear: the economic ties that once made North America a global powerhouse are starting to fracture, and the consequences could reshape international trade for years to come. There are three possible outcomes. The first is a compromise in which both sides ease tariffs and restrictions, restoring trade stability. However, lingering tensions may still push Canada toward greater economic independence. The second outcome is a full-blown trade war, where both nations impose further restrictions, leading to inflation, job losses, and a weakened economy on both sides. The third and most drastic possibility is a permanent trade shift, where Canada fully diversifies its trade network, significantly reducing its reliance on the United States and altering North America's trade landscape permanently. Now it is your turn. Who do you think will win this trade war? Will Canada emerge stronger, or is this a reckless gamble? Drop your thoughts in the comments below, and do not forget to subscribe to our channel.